Great. Let's get started. So welcome everybody to our semi-annual valuation webinar all about e-commerce brands. We did the last one in the end of November 2025, and delighted to be back in front of you all discussing the updates on valuation. Thankfully, they are positive. We've had enough doom and gloom over the last 2, 3, 4 years in e-commerce. Thankfully, there's incremental positive points to report on as we go through today. So to start, same format as our valuation webinars have been in the past. I think we've done over 10 of these now over the last few years. We'll just give you a brief update with what's going on at the Fortia Group, including the date for our next annual e-commerce M&A conference in New York. We will walk you through our H1 2026 valuation report, and we have a number of great guest speakers as we normally do today. And we'll hopefully have lots of time for Q&A. So from a housekeeping perspective, please do submit Q&A as we go through the Q&A tab on Zoom. Please don't put it in the chat tab. And as ever, recordings will be sent to you direct, and you'll also receive this PDF. But all the recordings of all our previous valuation webinars are on our YouTube channel. Just search the Fortia Group on YouTube channel to see how things have changed over time and track the positivity coming back into our space. Okay, so part one, update by ourselves, the Fortia Group. So please bear with me if you've seen this before, but just to give you context for those who are new to the Fortia Group, where do we sit? What are we trying to do here at Fortia? I used to work at Morgan Stanley, which is up there with Goldman Sachs, JP Morgan, some of the best M&A firms in the world. They're clearly dealing with the higher end of deal flow, typically at least a couple hundred million in terms of size, up to obviously several billion and tens of billions. Below that, you have the upper middle market where firms like Stifel, Hulu, and Loki operate. We're just below that in what we call the lower middle market. So we're looking to work with firms who are doing 10 million revenue up to 200 million revenue. Below that, it's sort of it's a sort of a technology or a database play where firms like Acquire or Flip are frankly better than we are at that level. So if you're getting close to 10 million or in the 10 to 200 million sweet spot, that's our bread and butter. Obviously, all we do is e-commerce led brands, so we're not sector agnostic. For 6 years now, all we've thought about every day with Paul, David, and myself, the three co-founders, is how do we position and maximize the effort and all the blood, sweat, and tears for the entrepreneurs when they're looking to have a successful exit. So that's our sole focus. Just to remind some of you all of the deals that we've done over the years, going way back, probably 5 years ago now, we did on the right-hand side a supplement business called BeLive that was sold to a German private equity firm. A few years ago, we did Upward Baby to a US aggregator. We did JFlex, a Utah-based business, a few years ago as well to another aggregator. And we did a large deal about 2 years ago now, selling a house of brands for tens of millions. So they're examples of what's in our wheelhouse, e-commerce brands ranging between 10 and 200 million. Thankfully, the market is improving, and we have 8 live clients with today, including 5 that we've listed here. So, for example, on the left-hand side, we have an LOI signed for an 8-figure US-based signage company to a US private equity firm. And we are on the right-hand side, we're working with a 9-figure Dubai-based DTC beauty brand that's growing incredibly fast. So there are deals live in the market. We've got up-to-date feeling for where buyers are at, both across not just aggregators, but also private equity strategics, family offices. So that's really important. We're speaking to e-commerce acquirers all the time. One of the favorite things we do every year now, this will be our 5th annual e-commerce M&A conference. It's in the same venue, convened venue in Lower Manhattan. It'll be on the 8th of March, 2027. It's a conference aimed at acquirers of e-commerce businesses. Again, that can be private equity strategics, family offices, aggregators. but we also invite a select number of our e-commerce brand clients, our prospects to attend, where you can pitch in a sort of a formal Shark Tank type format. Or you can just sit at the back of the room and listen in and absorb and sort of help you think about how to come to market, even on a 1, 2, 3 year basis. So please do put that in the diary, register via the QR code, and we'll follow up with some more information. But that's the only annual e-commerce M&A conference globally by any firm. So it's a super day, and hope lots of you can make it. Okay, so the speakers that we have here today, we have Pattern, Matthew Kelly from Pattern. Pattern actually were a great sponsor of our last conference in New York. We have Austin Gardner-Smith from DryPoint, who continue to be a great partner of this webinar. They produce really interesting data points that are linked to the valuation of publicly listed e-commerce comps. Paul, my co-founder, who led e-commerce for Water Wipes, the largest baby wipe company online, he gives his perspectives. eComplete, we're doing lots with Joshua and colleagues at eComplete, super acquirer of DTC businesses, and he'll give his views. And we'll finish with Robin. We're doing lots of work with Robin, and very efficient commercial driven lawyer. So lots of great speakers. So without further ado, let's jump in. Sorry, before we do, one advert, please bear with me. So look, we like speaking to companies who are thinking about an exit even 1 to 3 years from now. We're not just looking to take on mandates tomorrow to execute on a 3 to 6 or 9 month time frame. We can add so much more value to entrepreneurs if we advise them on a long-term sort of exit-ready process. So please, if you're looking to sell on a 1 to 3 year view, reach out. Let's have a conversation to think about how we can build value by getting feedback from potential acquirers, by getting all your ducks in a row so that you're not rushing your exit. Large companies on Wall Street, when I worked at Morgan Stanley, they're thinking 1 to 3 years out from an exit. They're not thinking, 3 to 9 months from an exit. That's amateur, frankly. So we're trying to bring a Wall Street level of discipline and thoughtfulness to the lower middle market in e-commerce. So please do reach out to exits at the Fortia Group or to Paul, David, and I, and we'd love to chat about rewarding you for all your efforts and hard work over the years. Okay, so this is our approach to determining where valuations are at. We have 6 ingredients or factors that drive ultimately the valuation range that we'll show you today. So the first is, what's global M&A activity doing? That has a massive impact on what we might get for selling an e-commerce brand. What are the e-commerce trends like? Are they positive? Are they negative? What are the public market comps trading at? That's obviously a barometer for private market valuations. What's e-commerce M&A activity like? So they're all sort of outside the control, the sort of macro, or sector factors. In terms of what's in your control, what are the brand metrics for your specific brand? And there's some context to that. Is it getting harder or easier to get higher net margins, etc.? Is there tariff issues, etc.? So we'll talk a bit about that. And then we've got to talk about deal dynamics. Is it a good time to do a deal? So for example, obviously in December 2021, there were loads of aggregators that were flush with cash and had to deploy it. That was a super time to do a deal. That's when valuations were at their peak. Sometimes you might find a buyer that has to put money to work by a certain period of time because they're moving on to their next fund. So there's lots of things. Sometimes you find sellers under pressure. They just want to get a deal done. They're willing to take a cut on overall valuation for a higher upfront cash fee. So look, there's loads of different dynamics that can drive a valuation, and Robin will touch on some of those. And then I'll finish up at the end by giving you our thoughts on where the latest valuations are at. So global M&A activity, section 1 falls to me. I spent many years, probably too many at the large investment banks. I saw the light eventually and left that world. But I joined the world of investment banking in May 2000, 26 years ago. That makes me feel old. But I like to start by looking back because I think we can learn a lot from history. And it's interesting to see after the credit crunch there, you can see in 2009, M&A volumes were at a serious low, sort of for obvious reasons. It took a number of years to get back to a meaningful level in 2015. And you can see in 2021, the going was great. 5.6 billion was the largest in the last sort of 20 years. Then we had COVID issues, which had a serious impact on volumes. But thankfully, interest rates have been coming down, and there's certainly been a big increase in deal volume, got to 4.9 trillion. This is for global M&A of all sizes. So 4.9 trillion in 2025. So look, that's good. That bodes well. So what's happening more recently? M&A values are continuing to rise. So if you look sort of year on year, first half of this year over the first half of last year, there's been a significant increase. That's great, but the devil's in the detail. Unfortunately, the number of deals is down marginally. So what that means is mega deals are driving the increase in the dollar value, not deals of, say, necessarily small and medium-sized businesses. But look, it's still a positive sign. The big ones will lead, and then we think the small and medium size end of the market will come and follow. As we look ahead, then, the three firms I respect the most from a global M&A perspective, Morgan Stanley, they think that global M&A this year could reach a record 6.4 trillion. So if we said last year was 4.9 trillion, the highest in a 20-year view was 5.6. That's a serious step up on where we are today. They're saying that's supported by strong equity markets, renewed corporate confidence, and a substantial private equity capital, a lot of dry powder in the PE world. Goldman and JP Morgan are basically echoing that. They're saying the cycle still has room to run. JP are saying that growth is broadening. There's clearly some risk to this. The obvious one is the AI bubble. Is it a bubble? What might make that burst? And that's frankly hard to call. But certainly right now the outlook is good for M&A. So from where we're sitting, the second half of 2026 is a good time period to be thinking about an exit. There's probably some risk to certainly the latter half of next year, certainly depending on, for example, if the AI companies can actually live up to their valuations and show ROI of their underlying clients and not just token spend for the sake of token spend. Okay, so that's the sort of context from a global M&A perspective. Now let's jump into e-commerce trends. And I will welcome my colleague from Pattern to take over.
Amazing. Emmett, thank you so much. And team, it's so good to meet all of you here on the webinar and to be with you. We love the Fortia group. We've been excited over the last years. We've made some good connections across this team. Today, I will be relatively brief, just by way of introduction. So Matthew Kelly, I help lead our private equity partnership team at Pattern. For context, Pattern is a global player when it comes to marketplaces and all things e-commerce, with helping brands perform well there. So it's a natural fit for us to have a private equity focused group that helps PE firms assess how their portcos are doing or potential portfolio companies. And so today, I hope to just give you a glimpse of what we're seeing as a massive player in the space of where the puck is going, right? So this is going to be pretty simple. We'll maybe only take 5 minutes or so. Let's move to the next slide, and I'll give you a bit of a insight, just overview, right? So, when you think about where your customers are and where brands play, of course, brick and mortar continues to be a massive player on that. 76% of global retail sales take place within brick and mortar. But when you look at the growth rates for the future, it's flattening, right? We all know this. We understand that. Marketplaces, D2C, social commerce, agentic commerce are where customers are continually going to look for your brands. And that's where Pattern plays. We're positioned across the board in those 4 primary segments, and always happy to connect on that. But what I want to talk today specifically about is those 2 far right areas, social commerce and agentic commerce, and how, as you're assessing brands within your portfolios or businesses out there that play within this e-commerce space, like the Fortia group focuses on, just things to be aware of. So let's move to the next slide. And I think the best example of this is, of course, TikTok Shop, right? When we talk about social commerce. These numbers are really hard to digest at a full view. So I'm just going to walk through them. But when we look at US monthly users, 170 million active users on TikTok Shop. This one takes me away. 95 US average daily minutes spent on TikTok shop, or sorry, TikTok as a whole. Um, 95 minutes. I was thinking about that and I'm like, that's the length of a lot of movies that we watch, right? So almost an entire film worth of content being consumed and viewed daily across those individuals. Um, 20 times daily open rate for that app. So people are after having gotten out of it, they are getting back into the app 20 times daily. You can see other large numbers that just really give an understanding that this is where customers and consumers are. And I think a lot of people for a long time have had maybe a question of confidence in the platform and everything, but that bottom right one, 3 in 4 TikTok users likely to buy well on TikTok, just shows that people are feeling increasingly comfortable with that as a place to spend their funds. Let's go to the next slide, and I'll talk a little bit about just this halo effect that even being within TikTok has on brands outside of TikTok. This is a story. I'm just going to read this for the sake of that, but you know, this is from a brand partner of Patterns. We had an impressive 18% jump in sales on our 3 affiliate items last week on Amazon. What particularly impressive is the fact that we cut our spend on Amazon by half, but yet we managed to drive more page views and increase our conversion rates. Even Amazon was puzzled by how we pulled it off. What this shows is that in this situation, this brand partner of ours, they decreased their Amazon spend, they focused a little bit more on TikTok, and they saw that halo effect taking place. If we go to the next slide, I'm going to be able to show you kind of a little bit more of the specifics on this. We believe that data can tell a really strong story. So here at Pattern, we've actually even looked at this from a standpoint of what is, can you can you try to repeat this, right? So halo effects tend to be a little bit broad, and it's like, oh, it's hard to repeat what's going on here, but we believe this is what the data shows. If a brand can get to doing 65,000 in GMV on TikTok Shop, that is when you start to see a halo effect. If you also combine that with focused investments into that channel and give it about 3 months. So if you have over 1,000 affiliate videos per month recommended to drive those sales, you're getting that 65,000. We anticipate, and what we're seeing in the data is that your Amazon, relative to that TikTok Shop business, will have about a 20 to 30% increase. So if you just look at that graph, right, if you're doing 5 million in GMV on TikTok Shop, you should see that impacting Amazon by about 1.5 million and so forth. So just some general numbers there. We are also always happy here at Pattern to be as helpful as we can to you in assessing these things. We can always look at it from a portfolio company standpoint, kind of give our view there. Let's go to the next slide. Just have a couple more here, and then we'll move on. So traditional search, right? We are a search bar generation. We've spent a lot of time using search bars to look at things. It's what people are very comfortable with. Agentic discovery is basically using LLMs and agents to be able to get almost a suggested area to focus on your product search and everything like that. And how are you finding products? I had my first experience with this, and I'm looking. We've got about 50 people or so on today's call, or there might even be more across the group. But as I think about what we have. Well, let me take a step back. So what I want to share with you is just an experience. I feel like this is a group that won't judge me for this, that you guys are probably all going to get a kick out of this. I was driving in my car, stuck in traffic, and this is about 2 months ago, and I was looking in the rearview mirror, and I started to notice, I looked at my head and I was like, man, I feel like my hair's not sitting quite like I like to, and maybe I'm just receding more, maybe that's part of the process. I'm always, we're all getting older at times, and I actually, I was like, man, I'm going to turn to Gemini. So I had Gemini, I took a picture of my hair and I was like, I feel like it is sitting so flat. What's going on? Am I just losing hair or what's going on? And it asked me what product that I was using. And I had bought a product a couple weeks back that was not doing me any favors, is what AI told me. It said, you're using the wrong product for your hair mat. You need to go get this product. And I used it, and instantly after using it, I was like, oh man, my hair's back to what I remember it. So just kind of a funny personal experience that hopefully, I know I can't see you all laughing, but hopefully you're getting a good kick out of that. But this is how people are finding products now, just like I experienced on that. Let's go to the next slide there. Okay, so we at Pattern have access to a lot of data. And one thing that we can do is a GEO scorecard for brands. And this is basically just when you think about visibility and sentiment, what does AI view and perceive of your brand? So from a visibility standpoint, is your brand able to be caught and seen by agents out there? And when agents do see that, is it a positive sentiment? So this was a brand, we sanitized this slide, but we were basically able to kind of give prescriptions and say, hey, this is what we would focus on if we were in your shoes. Your brand is very positively perceived by AI, but it's really hard to find it. It's not visible. And so we can kind of give suggestions on how to make that more visible. All right, let's move forward to the next slide. I've got just a couple more here for you as we talk about this. So today we've talked a lot about social commerce. We've talked about using agents to find products. We anticipate a significant shift where AI in that same space is where you'll be purchasing those products consistently more. This is something that I think is top of mind for everybody. But as you just see certain quotes here from Bain and Company, McKinsey, Morgan Stanley, you can see by 2030, just the Bain and Company one there. By 2030, AI will touch most online shopping in some capacity, completing up to a quarter of transactions. I mean, those are very realistic expectations from our view of what we're seeing out there. And then the last slide here that I'll just hit on is why all of this is important. Why does our team exist and why are we focused on this? It is because within the private equity space, we want to help brands and PE firms and investors to have strong valuations, to have strong exits and everything. This is just a small glimpse of a group that we worked with over the time of our partnership. The company, was acquired after we were able to enable them to 10x their initial revenue from when we joined with them as partners. So this is where we play, and always happy to give some assessment and our take on it. That is what I have shared for everybody today, and hopefully it's been helpful. Thank you, Emmett.
Thank you, Matthew, and thank you for sharing that story, which will forever be on YouTube, on the Fortia Group YouTube channel. A very honest example of a personal use case. Fair play.
If we're not authentic, what are we, right?
Yeah,
So there you
yeah.
go.
You're here. Fair play. Thank you, Matthew and Pattern. So let's move now to public market comparables, and I'll welcome Austin to the floor.
Hey, Emmett. Hey, everyone. Thanks for having me again. My name is Austin Gardner-Smith. I'm the co-founder and CEO of a company called DrivePoint. We are an AI finance platform for consumer brands. So we help brands aggregate their data across Amazon, DTC, retail, all their channels, as well as their financial data, pull that together, and help with analytics, forecasting, planning, and all kinds of other stuff. So as part of that work, we're often involved in the intersection of our brands and our customers and the capital markets. And for the better part of 5 years now, we've been tracking a set of public market companies that we believe best represent sort of the heart of DTC, or it's expanding more into omnichannel with a little bit of favor for DTC. So you can see some of the names down below, a relatively diverse set of companies. There are not a ton of public company names, so it's not the biggest data set in the world, but it does give us a good deal of insight about what's going on. So just to give you the latest reading, so if you flip to the next slide, the DTC index, this is the reading as of yesterday or as of Monday. So the median line is kind of what we tend to focus on because the averages can move around quite a bit. Average brand or sort of a medium brand in the basket, growing, not growing super rapidly, about 75% D2C revenue, gross margins. The median is 56% on the gross margin side. EBITDA margins just about 7% as the median, so not wildly profitable. And the current marks are EBITDA sales of about 1.27, 1.3x, and EBITDA of about 15x. So we've seen quite a bit of change over the last little bit. If you flip to the next slide, this is sort of like the historical picture. And I know, Emmett, you talked about this a little bit already, but just to pull this sort of monthly data, right? We had this sort of almost, historically looking back, anomalous set of data points in the 2020 timeframe where we had some of these companies coming out for IPO and doing really, really well and trading at very high multiples. And then a relative period of stability in 22, 23, 24, EV to EBITDA kind of hovering just south of that 10x multiple. EV to sales really kind of hovering right around 1x. And over the first half of 26 is the first noticeable sort of deviation from that mean that we've seen. So we have seen those valuations tick up to this latest reading relatively into the double digits on EV to EBITDA. A lot of that I think has been driven by two big things. My read is that there are a couple of things happening over the top. Obviously, AI and everything that Matt was talking about has been sort of the dominant theme, I think, for most of the markets, including the public markets, over the last couple of years. There is a very interesting counter narrative, I think, to AI of like, okay, well, what are the industries that won't be disrupted as much by AI? People may stop buying as much software, they may stop doing as many things, but we have seen an interesting tailwind or counter narrative, both in the private capital markets, I think, and in the public markets, of people actually reverting back to consumer and durable goods as an interesting place to put money in a world where AI will be disruptive to many other industries. So AI not likely to disrupt the beauty market, other than obviously on the marketing side, but people aren't going to use AI to fix their face. They're not going to eat AI. They're not going to wear AI. And so consumer in many ways has become a bit of a safe haven for some investors, which I think is driving some of these valuations. So very interesting, sort of like the first meaningful change in this chart over a couple of years, which is great to see. If you flip to the next slide, a couple of just key insights for us. Profitability still commanding a premium. There is a bit of a divergence or sort of a bimodal distribution in these data sets. Basically, brands who are profitable, even relatively uh, with thin profitable margins, are trading at almost 2x sales, as opposed to those who are loss-making, who overall the public markets are valuing at less than 1x sales, which is very interesting. There are obviously some outliers here. But that profitability premium is still definitely there. Once you get into the public markets, you're just dealing with a much broader set of investors, and they will prize profitability in their analyses for sure. We do see some pretty interesting spreads. So that last bullet point on the right, just as an example of two relatively comparable or sort of similar industry type of brands. Birkenstock has been absolutely ripping and now leads the index at 3.84x sales. Lulu's Fashion Lounge also in the apparel category, trading below its 1x sales as it's declining. So a big difference in spread between those. So profitability definitely matters. We are seeing that growth driver sort of be the thing that people are after. And we've seen some interesting falls from grace over the last year as well. So Birkenstock now sitting at the top of the index from a multiple standpoint. Lululemon, which was the shining star for almost the entire history of the index, has actually traded down quite a bit. And at one point was sitting at, I think, 30 or 35 times EV to EBIT, and has now really come back to normal despite continued growth of both revenue and EBITDA. So some changing of the guard going on in the index, which has been very interesting to see. You can flip to the next slide. Just a little bit more information here. The are a couple of pieces here to sort of look at. We often get this question, and I see Joe, I think you had or Joe Robert, you have a question about sort of like live mix as well. So this will touch on that a little bit, which is to say that like we typically are seeing higher margins for companies that are able to execute across more than one channel. So we classified these pure D2C brands. There are 10 of them in the index that are over 80% D2C, and then this hybrid segment of kind of 40 to 80%. And obviously much higher revenue in the hybrid section. So there's a little bit of scale premium here as well. But you can see just that median EBITDA percentage, the pure D2C brands operating at about 4% median EBITDA. The hybrid brands considerably more profitable, about 10 percentage points more profitable, and getting some credit for that in terms of valuation as well. So I think the answer is basically that the markets like more channels. It's not an automatic bump, but more channels will get you more credit for durability. And they also typically coincide with scale. So oftentimes we'll see brands, especially that we work with in a relatively similar space to where the Fortia group specializes in the lower middle market. They get to a certain point, and then the economics of continuing to scale on D2C or Amazon start to erode somewhere, ballpark in that 20 to $50 million range. and they look to add wholesale or retail as a channel, both to increase scale and potentially to increase total margins as well. It just doesn't take as many unit cost resources to scale in wholesale. There are significantly more startup costs there as well. So, anyways, just a couple of key insights to share on that piece, and probably the most movement that we've seen in the index over the last 6 months versus the prior 2 or 3 years.
Thank you, Austin. I'm going to go back to that chart. That's one of my favorite charts of the last 5 years. Finally, all the patience has paid off of sticking as a business. We've stuck with the e-commerce brand as our sole focus, and it's great to finally see an uptick. And for everyone on the call, it's encouraging. Clearly, there's a discount for unlisted private firms, but it's going in the right direction. Super. Thank you, sir. Cheers, Austin. Okay, now we'll discuss private M&A activity, and my colleague Paul will take the floor.
I was just checking you can hear me, yeah?
Loud and clear, yep.
Great. So to the tune of your section, I want to first of all focus on mega deals, which are of course driving a significant portion of deal making in the consumer space, consumer brand space. Strategics leading the way here. I wanted to show the Unilever scale, just to show there are, of course, mega deals within mega deals, but then try to reference some deals, of course, below this that have significant e-com, particularly DTC focus. Interesting to see it's predominantly led by strategics. Some of these are availing of crazy assumed EBITDA and assumed EV to revenue multiples, but it's interesting. Obviously, we've got a shift in focus of those focusing and doubling down in either supplements and beauty. Beauty continues to have a good surge in consumer brand activity. But if we flick to the next slide, we'll see what's driving these acquisitions, and then finally what this kind of means for the lower middle market sector. Lower middle market sector for us ultimately is anywhere from 10 million to 200 million enterprise value. So it's portfolio focus. It's driven by a focus. It's not distress. It's those doubling down in their niche. And ultimately, we see this in the lower middle market as well. Everybody knows that the aggregator community have gone through a big shift in focus. We see this in conversations that we're having with private equity as well. There's huge significant scale here. So not getting out of one step in terms of insights, in terms of resources, in terms of trying to cover all sectors seems to carry through from these mega deals and conversations that we're having in our sector as well. There's a conversion to top consumer sectors, as you can imagine. Nutrition, supplement, personal care still leading the way. GLP-1s continue to dominate headlines. Anecdotally, I see an enormous shift, as I'm sure we all do on the call, of wellness brands popping up to support that GLP-1 shift. Most notably IM8 and brands like that building off the traction there. But we see big conglomerates like Danone, like Unilever doubling down on these sectors, driving some large transactions to limit the diversification and double down into those sectors. They're buying for proof, not awareness. So obviously nobody can argue with the scale of e-com and how quickly that can scale, but there's still an emphasis on being able to prove the longevity of that revenue, not just launching at all costs across products, portfolios, and customer acquisition channels. It's also we see a premium in some of these mega deals, valuations being cited because there's significant proof, either social following, in IP being purchased, or just in repeat purchase customer rates fueled significantly. And then there are purchasing obviously for digital capabilities. So strategics and private equity, of course, wanting to double down into efforts across e-commerce channels, continuing to present logical cross-sell and upsell across the portfolios there. And Grün's obviously taking advantage of that. Next slide, Emmett. So ultimately, what does this mean for lower middle market entrepreneurs or brand owners that would be on this call. The multiples of these mega deals are a reference point, as is Austin's materials. It's not necessarily a direct comp, but a really interesting one that ties into a wider valuation service. We spend our time, tracking not only mega deals, of course, but all consumer deals. And think of it as a rung down. They're still underwriting and they're still purchasing for the same things. Repeat purchase rates are being scrutinized, the ability to access first-party data, the strength of IP and what that really means. And then I think a big one for this call, if there was a key takeaway, they want diversification. There's still an element of risk, and they're looking to diversify that risk, diversify it across products, the channel mix, customer acquisition channels, etc. So think of it as, yes, size gets a new unlock for different multiples, but with size would be assumed increased diversification. Think of Huel's significant scale through DTC, but then accelerated massively through the retail angle that backs it. Carve out, so it's driven by focus, not distress. There's a preference for strategics to double down into their niche and make efficiencies there, as was the original play of the aggregators. And we see that, funneling through to private equity conversations we're having. So why is this important and what does it mean? It's important to understand who the players are if you're targeting in your certain category. And as Emmett says, we do a lot of work with brands, even 2 to 3 years out from an exit, positioning them in front of those targets and understanding what the strategic synergies are. I love those calls because I find the buy side are so willing to give their strategy, what their focus is, and 5 or 6 of these calls, and it gives good insight into the founder, to what decisions they can make and expand into. We see a lot of our clients from those calls deciding what channels to launch into or what to leave on the table, or in terms of where to prioritize their efforts to generate more revenue. And then I would say, while strategics are obviously propping up, these mega deals, because of course they're acquiring for something that's a needle mover, significant market share or dominance in a particular market. Private equity continues to be a stronghold for lower middle market, bolt-on deals, tuck-in deals, and they've got huge exposure there. So scale the proof, everything that we've spoken about from what drives significant value in mega deals can be replicated at that 10, 20 to 200 million EV. Talk about channel mix, product mix, repeat purchase rates, and strength of IP. 60% subscription revenue and a defensible IP will tell why, Danone paid over 4x revenue to EV multiple to purchase Huel. I think that's my segment, Emmett. Oh, sorry. One nod, of course, then to the differentiator between US market and EU, UK buyers. Europeans buying for growth. Obviously, there's a huge market in US for UK targets available, and US are buying for focus, doubling down. So US obviously is the differentiator there. Interesting for EU targets and UK targets, where they've got a significant market available for expansion. Uniform market, not fragmented like EU and other markets. So really attractive, naturally lends itself to some higher valuations being demonstrated. Interesting for anyone who owns a EU or UK brand on the call looking to expand into US. There's a premium there for acquisitions.
Great. Thank you, Paul. Now we're going to jump into brand metrics, and I will invite Josh to the floor.
Thanks, Emmett. Much appreciated. Great to be here with everyone. I'm going to take a moment really just to sort of look at what we've seen as an investor and as an operating partner. Our business model lets us sort of get close to brands and see what is affecting the makeup of a business on a day-to-day basis. So I think moving on to the next slide, we probably have one real sort of zoom out, on what has happened recently and the impact that brands have faced in terms of technological change, advertising change, and just some of the nature of how businesses have had to operate recently. We really think that the landscape has been redrawn. We've certainly seen many founders, management teams talk about the impact of Andromeda and what effect that has had on their business, the way that they're operating their business. Obviously, tariffs has been a huge point that has come in to create impact. We think that consumer confidence has been very interesting, especially given the sort of broader macro landscape. You think about conflicts in the Middle East, you think about purse strings tightening, and at the same time, there are more brands than ever trying to take a share of the wallet. So category saturation has grown, and at the same time, we have this backdrop of AI really coming in to challenge businesses. It's a new technology, it's a new noise that's there for founders. And from a business perspective, from an investor's perspective, we see these mega deals that have come into play that have created a new precedent for how these big businesses might be seen in terms of valuations. So all of these forces really do push operational change. I think if we go to the next slide, just taking that one step further and trying to pinpoint some of the things that will have happened in these businesses, we see a lot of management teams trying to rebuild creative engines around the Andromeda shift. That might be outsourcing to agencies, it might be bringing more talent and capability in-house, investing in new means of trying to drive creative at scale to support the demands of Meta. Supply chain teams have had a really, really hard time. Operations teams have had a really hard time trying to adapt to the narrative and the constant shift around tariffs, which inevitably has a direct P&L impact for a lot of businesses. We think that AI has created, distraction, and I think it's been hard to see the tangibility of how that comes through to impact businesses. So far, it seems like both a time cost, a financial cost, but there are real green shoots to show that this could give great operating leverage, and it's certainly part of our perspective at eComplete. It's something that we are looking for and something that we're actively working to develop. But with founders that aren't in the know, there's that tension point. We see a lot of founders that are sort of asking the question of how does this work for my business? How do I use this to my advantage? And then obviously the nature of an attractive P&L, attractive unit economics because of mega deals have really shifted. So it's been an interesting time, and you see the impact of that come through in P&Ls, you see it come through in valuations, you see things that provide advantage or disadvantage to founders and management teams that are maybe trying to go through an exit. And if we move on to the next slide, I'll just try and sort of dial in on what I think some of the sort of new outlook is for brands and for teams. I think it's no surprise that some of the mega deals have forced this, this not just operational excellence requirement, but a real need to build the unit economics around a business that can scale sustainably. We sort of see this 80-20 situation. We think that most businesses now are having to strive for at least north of 70% GP, but the best businesses are operating at 80. Quite hard when you think about the impact of tariffs, the China supply chain, the shift that might have caused, trying to de-risk that if you are selling actively into the US market. And then at the same time, we see a lot of businesses that perform extremely well, between the 10 to 20% EBITDA range, but there's a demand really, I think, for hitting that 20% EBITDA range and doing so consistently. And this really brings us into a point around demand. And I think if we progress on to the next sort of view, what's been interesting in the brands that have managed to protect themselves from some of these headwinds is that they've really been able to protect value via different means. And I'm going to take a moment just to zoom into this idea of influence, not just influencer marketing, but some of the brands that are really succeeding, seeing exceptional growth, standing the test of time, being able to build real consumer loyalty. They have, talent, audience, and influence in place, and there are some really brilliant brands here. Rode, one example of a mega deal that has happened recently, and other brands here that you can see that have built in serious traction. Some of the accolades around these brands really do resemble that. In the UK, we have the Sunday Times Fast Track 100 and the Phoebe Growth List, and you see P. Louise and Six Stories. different levels of influence, great founder-led businesses operating via different channels, one extremely great at activating TikTok Shop Live, another one that's been brilliant in carving out a fairly new spot in a market, a traditional market. But real examples here of how owned demand can help you drive forward and maybe feel some of those operational headwinds a little bit less. And so, stepping on, I think most founders would love the luxury of having, a celebrity in their ranks. They'd love to have somebody on the cap table, a founder, a potential investor, or have some sort of influence that comes via personality. And if you don't have that influence, it really pushes you towards operational excellence. And so on the next slide, just a couple of examples that help to demonstrate this. I think Paul just spoke extensively to Grunes and to Huel. We thought Huel was very interesting as a sort of mega deal. One thing that was probably prevalent for Huel was, they've been around for a long time, have certainly benefited from a cheaper advertising landscape back when they first started and were heavily leveraging Meta for acquisition. But talent has played an interesting part in that journey, leading sponsorships of podcasts, big personalities, etc. At the same time, you look at their team and you think about how their team has conveyed themselves. There are public signals that show that they've been able to actively leverage AI and use that technology to drive operating leverage. So it's no surprise that Danone has written a pretty hefty check. We believe here at eComplete that not only is it on the premise of a really good business that demonstrates operational excellence, but actually there's portfolio benefit by bringing the learnings, and almost an argument to say that they may have acqui-hired with Huel. The Beauty Tech Group, a business that we're invested in, went to an IPO back in October of last year. And that is another business that demonstrates extreme operational excellence, very data-driven, very commercially driven in the way that they manage marketing channels and internationalize. And we think that another really, really good example of how brands are trying to fend off the ever-changing landscape and really lean into operational excellence. And so I guess onto the next slide, one thing that we're probably looking at as investors, and as we look at progressing deals, we invite our network of investors into those deals. So we think from their perspective, from our perspective, but also from an operator's perspective. And these are really quite interesting metrics that we're probably thinking about. And these are metrics that have a long tail impact that demonstrate the way that a business is operating, and shows that potential increased value in a business. We think quite a lot about revenue per head count. One great example of that, we have a brand called NatureCan in our portfolio operating in 45 plus territories. And when you speak to the team there, their thesis for internationalization is to have a single head supported by a central team trying to grow out and drive each of those territories. So the operating leverage becomes real there, a team that's very much enabled by AI and great data. And at the same time, we're thinking about this shift in capabilities. There's a need for teams to do more and to be able to drive that leverage further. But a lot of the same metrics that are important really still ring true. First order profitability, LTV to CAC, a controlled cost of sale. These are all things that we think are really important to both ourselves as an investor, but the more traditional private equity firms that exist. There are a lot of questions that tend to arrive around these types of metrics once you move beyond, simple unit economics and the shape of a P&L. And we think that, the impact of AI, one sort of best way to demonstrate that is likely to be a real shift in sort of OPEX and salaries as a percentage of net revenue, seeing that trend over time. That's probably one of the most important points I would make on this basis, is that really it is about the trend and direction of a lot of these KPIs and metrics that is going to be the thing that really plays to your strength as a business that's looking to move towards an exit or a transaction. Can you show that you've weathered those operational changes and those forces that are really out of our control as operators? And so to round things out, just a perspective on how we're trying to help brands and how we're thinking about driving our own approach forward to investing. And so the next slide, really a big way that we're trying to do this is by reinventing the commercial due diligence process and product. We're trying to make it, rather than a flat, static document that most will receive to go and sort of help them during a transaction. We're trying to get in a lot earlier to help founders and think about how they can, one, optimize their business, think about the value creation levers available to them, but then create this living environment where post a transaction, there's an ability for founders, management teams, and investors to have real alignment in what the North Star and shape of a business must be if they're looking to go on to a future event, a future exit, or to achieve their growth targets. And so we're placing a lot of focus on building out what we think is an operational brain for businesses. And the final slide in my section, the next slide, really sort of points to where we see things going. We think that this operating brain becomes a really important part of how e-commerce businesses will move forward. And it's been able to scale on a very, very lean operating team, but being empowered by an agentic workforce, which was hinted to earlier. And that's where we're placing a lot of effort as an operator, but also looking at how we can bring that as a benefit to any of the brands that we invest in. So it's a little bit on how we see things. We think that a lot of these dynamics are ultimately impacting valuations. We think that businesses that don't manage to weather these operational storms are ultimately being chipped in terms of price and valuation. We think that the best brands are really excelling in a lot of these areas, and we think that's demonstrated by the mega deals who have set a precedent for how founders need to think about operating their businesses. And with everything, I think the Fortia group team will sort of echo this sentiment. Preparing for an exit has to be done with intent. You have to be doing it years in advance, months in advance, and thinking about what the shape of your business needs to be for that transaction. So that's my session, and hopefully some useful insight for you there. Back to you, Emmett.
Thank you, Josh. Super. Always great to have acquirers on this call, giving granular, practical, real-world advice to the audience. So thanks again, Josh, as ever. So now we'll go to Robin to talk about deal dynamics, and then I'll finish briefly with valuation. Over to you, Robin.
Okay. Hello, everyone. How are you? Let me make sure that everyone can see screens here. So I am here to talk today about legal deal structuring. Are you controlling the slides here?
Correct. Yeah.
Okay, great. Yeah, next slide. So the infamous legal mumbo jumbo, this is friendly information provided to the Fortia group and obviously not intended to constitute legal advice. Can you go to the next slide? So who are we? I am the founder of Speed M&A. Speed M&A is a proprietary, legal process for doing deals, both buy side and sell side. We really approach M&A from an efficiency position, both from a cost perspective and a doing perspective. We do 80 to 100 deals a year in this space. So we see a lot of what's being talked about today. Next slide. Okay, so I was asked to talk about kind of the impact of structure on, deal dynamics. And I always break this up into 3 sections. One being the economics of the deal, the second being the impact of taxes, and the third being the treatment of liabilities. So we can go to the next slide. And here, when we think about structure, we think about both the actual, structure of the deal in terms of how the acquisition is going to be structured and the structure of the consideration itself. And, more often than not, we are not seeing sort of all cash deals at closing in the lower middle market in particular. We are seeing a combination of cash and equity. We are seeing earnouts. There's seller financing happening. And as many in this group know, I often talk about that we spend a lot of time on valuations and, top level enterprise. But what I really tell clients to focus on, particularly on the sell side, is dollars in pockets. Because, a lot of folks are able to get higher valuations these days by relying on earnouts. And a lot of those earnouts are not ultimately realized. So when you're thinking about structuring the earnout, you really want to push for a revenue-based earnout rather than an EBITDA-based earnout. I will say we mostly are seeing EBITDA-based earnouts, but that is where, control becomes a real issue for the seller, because the downside on the EBITDA can be burdened by a buyer who really feels that the business needs, additional resources and support. The other thing that I really pay attention to on the earnout side when it comes to increasing value and likelihood is what are the promises or covenants that you can get in the document when it comes to how the business is going to be run on a post-close basis. Most buyers will resist providing any contractual rights as to how that business is going to be run. But if you're going to sell a business and you know that you need certain key players, or, I had one deal where their purchase order response process was really the reason that they had had so much success in their particular industry. And we needed to make sure that the buyer didn't do anything to interrupt that flow. So in that case, we actually were able to get a contractual agreement that no one would be changing the way that they were doing purchase orders. So, this becomes a lot of the devil's in the details. With equity and the second bite, we all hope for the second bite. We don't always see it, but one of the big questions becomes, what are your rights in the process prior to the second bite, and making sure that you have access to the information that you need to continue to understand the value of your equity. So, as a general matter, folks are pushing for cash at close, but we are definitely seeing in the lower range of the market a variety of ways that consideration is being divided up so that the buyer is spending less at closing. Next slide. To me, the most important part of thinking about structure really comes down to taxes. Most folks are pretty familiar that main deals can be structured in one of two ways from a legal perspective. It could be structured as an asset sale where the buyer is only buying the assets of the company. I call it buying the furniture that you want and leaving the house behind. Or in an equity deal, you're buying the whole house with the cracked foundation and all the furniture inside. Asset sales and equity sales are actually taxed differently, as you may be familiar. An asset sale is actually taxed based on an allocation of the assets by certain classes under the IRS rules. And certain of those classes, particularly tangible assets, for example, are taxed at ordinary income rates, where other assets, intangibles and goodwill, are taxed at long-term capital gains rates. And that can have a material impact on your dollars and pockets. It's also interesting that the way that a deal is taxed, whether it's an asset deal or a stock deal, is very dependent on a state-by-state basis. Tennessee has a separate franchise tax in an asset sale. California has separate taxes in an asset sale. And so it's really important before signing on any, bottom line, even before getting into exclusivity, to at least do a back of the envelope determination of the impact of having the deal taxed as an asset sale versus a stock sale. Oftentimes, folks don't realize or they forget that even if from a legal structure standpoint, you have a stock sale, the buyer can actually structure that stock sale in a way that it is treated as an asset sale for tax purposes. And so it's really important before you sign an LOI that you know not just how is the deal structured legally, but how is it taxed and what is that impact going to be to you? This is particularly important because there are a number of sellers who actually will ask for a gross up in the tax difference between the asset sale and the stock deal. And again, next slide, I know my time is short here, but I wanted to at least get these concepts out. So finally, and this is one of these sort of hidden gems that people don't pay as much attention to, we often understand that a deal will be reduced by the amount of debt that the company has or that the company is paying off at closing. But what people don't pay enough attention to is what we refer to as debt-like items that reduce your purchase price dollar for dollar. And the main ones are accrued employee liabilities. So if you have unpaid, accrued bonuses, or if you have accrued PTO, the buyer is going to expect to reduce your purchase price dollar for dollar by that amount. Now you might say, well, wait a minute, it's only July. I've accrued bonuses to July, but I don't pay them out into December. And what if those folks aren't there? And that's when you could actually negotiate an alternative where you could get reimbursed for the portion that's not actually paid out. And then pay real attention to deferred revenue, right? Deferred revenue is money that you've received for services that buyer is going to have to service later. And buyers want to reduce purchase price dollar for dollar for those amounts. The compromise position is to only reduce purchase price for the cost of servicing that deferred revenue. And your best position is to put deferred revenue into net working capital. So the real takeaway is to say, when we're looking at enterprise value, that doesn't always translate to how you actually make sure that you get the most value into your pockets. And you have to pay attention to how the deal is being taxed and where there are hidden reductions in purchase price to ensure that you're getting the ultimate value that you're looking to get out of your deal.
Great.
There you
Thank
go.
you very
I
much.
did it in my 5 minutes, Emmett.
You did it. Thank you, Robin. And for all the listeners, most of the speakers were at our last conference in New York in last March, and hopefully we'll be there again next March. It'll be a great opportunity for you all to meet them in person and chat through some of these items on a more bespoke, custom basis. So I'm going to do, and I appreciate we've slightly run over, so I'm going to do valuations as quickly as I can. So this is, look, the key slide. So we've gone through 6 different factors that drive valuation. So to summarize, we'll send this deck out as a follow-up, but I just want to give you where we score each of the 6 items. So global M&A activity is really high. It's 8 out of 10. You've seen the forecast. We think this year could be a record year. E-commerce trends are improving. You've seen some of the data points from Matthew. Public market comps have had a great uptick. You've seen that we've been treading water, going sideways for years. You've seen the chart from Austin. So we're giving it a 6. It's still not back to obviously the highs, but it's encouraging. E-commerce M&A activity is doing better than it was. That score was 1 or 0 2 years ago, or certainly in Q2 last year, the tariff quarter was 0. There was no M&A activity really, or very, very little. So things are improving slightly there. Brand metrics still quite tough. For operators to get high gross margins and net margins for all the obvious reasons. So we're scoring that as 4. Deal dynamics we're saying is 4 out of 10 at the moment. So overall, we're scoring today's climate for valuation at 31 out of 60. For reference, 6 months ago, our score was just over 20. So we're seeing a significant uptick, which is obviously very positive. So where does that leave us? Here's our valuation indicative valuation ranges. So we look at distressed, growing, and profitable, and diamonds, the best brands. We split those into marketplace, i.e., Amazon-led brands, Amazon FBA-led brands, or DTC Shopify-led brands. So look, distressed is tough. In some cases, we're seeing people just selling for inventory, frankly. But typically, it's the ranges shown here: 1 to 2.5 on the Amazon side, up to 3 on the DTC side. For growing and profitable brands that are doing, at least 5 to 10 million revenue, we're seeing 3 to 5x. And bear in mind, this includes upfront and deferred revenue. And this is what we're typically seeing, right? So there are exceptions to the upside and on the downside. Probably not on the upside on this particular chart. The brand that got the highest multiple in December 2021 that we heard of was 7x, and this is our space. 7x won't be achieved again. It's incredibly unlikely. So maybe 2 to 5x is more realistic. On the DTC side, 4 to 7 is absolutely realistic for a good, profitable, top line growing revenue brand. And on the diamond, look, we've seen, Paul showed you some examples where there's brands getting way beyond 14x EBITDA and serious multiples of revenue and EBITDA. So if it's high subscription, if the growth is fast, as some of my colleagues have said, it's not just about the quantum of revenue or EBITDA, it's about growth. Growth is a key driver for valuation. If that's all there, yes, you can get 20, 30 x, 40x, maybe if you're Huel selling to Danone. But typically for the lower middle market, this is where we see most of the deals. So again, just like to reiterate, if you're thinking about an exit in the next 1 to 3 years, please don't just rush into it. Be thoughtful, like big corporates and Wall Street CEOs. Think through these things. Plan on a 1 to 3 year view. And look, we're here. We've been here for the last 6 years. We'll be here for the next 10, 20 years thinking about e-commerce brand exits. So please do reach out to exits at the Fortia Group to see how we can help you. So look, we've run out of time. We're already over, so I won't do any Q&A today. But I just want to thank Matthew Kelly from Pattern, Austin Gardner Smith from DrivePoint, my co-founder Paul, Joshua Elliott from eComplete, and Robin Sears from Speed M&A. Thank you all for participating, and reach out to myself or any of those speakers if you want to dig further into any of those topics. Thank you. Have a super day. Cheers.